According to Raymond James Chief Investment Officer Larry Adam, December added a question mark to the end of an otherwise strong year of growth for the equity markets, as inflation numbers continued to stagnate above its year-over-year target. The Federal Reserve, despite cutting current interest rates by another 25 basis points, expressed diminished confidence in inflation reaching its 2% target. Back in September, investors expected 4 rate cuts to arrive in 2025. Now the expectation is only 2. This news caused a chilling effect in the markets, resulting in a flat month for the S&P 500 and a 5.3% loss for the Dow Jones. Only 3 of 11 equity sectors were positive for the month of December. Continuing a now familiar trend, mega cap tech stocks stood strong while volatility ruled elsewhere in the market. Small cap stocks were hit the hardest, with Russell 2000 dropping 7.8%, reflecting their perceived vulnerability to higher interest rates relative to their larger peers. We've been highlighting the need for caution in the near term as investors are over-optimistic and the market is priced for perfection, leaving it vulnerable to any disappointment. Longer term, we remain constructive on equities as solid economic growth should keep earnings on an upward trajectory. The U.S. economy added 227,000 jobs in November, a strong recovery following a weak but revised upward October report. The Household Employment Survey, however, provided a different picture, showing a large decline in employment by 335,000 workers. This pushed the unemployment rate from 4.1% in October to 4.2% in November. Headline retail sales numbers remained strong in November, aided by car sales and online sales, but those strong spots hid weaknesses across other retail sectors. December's report will be important to shed more light on the relative strength of consumer spending. The Fed's surprising tone on inflation and messaging about future rate cuts caused the 10-year Treasury yield to sharply jump from 4.17% at the end of November to 4.57% at the end of December. Despite continued historically low relative spreads, corporate and municipal bond yields have pushed higher along with Treasury yields. Income-producing investment portfolios benefit from the increased yield environment, providing a continued opportunity to lock into higher income streams for longer. The upward sloping curve present in both the corporate and municipal curves means that investors are rewarded for taking on longer spans of interest rate risk. For the second year in a row, equity markets demonstrated powerful, though uneven, growth, and the U.S. economy remained resilient. Despite some dents in the armor, the corporate earnings outlook remains healthy. And while still above target levels, inflation has declined. There are clearly perceivable risks: inflation, consumer spending, investor confidence, and international trade. But at the end of 2024, the outlook for 2025 is confidently positive. And that's all for this month's market recap. If you or your family have any questions, please don't hesitate to reach out anytime. And as always, thank you for watching and have a blessed day.